This segment deals with business entity structures, presented by Mark Wood, Kansas Farm Management Association, Kansas State University. Here we'll deal with strengths and weaknesses of LLC, partnerships, S Corp, and C Corp. Effectiveness of each business entity structure related to having a sound business succession plan in place.
I've been invited to come and talk with you a little bit about some of the business entity structures that are common across businesses, not only farmers but non-farm businesses in small town, midtown, could be the largest corporation in the world. Oil companies use business entities as well. So I'm just going to review the basic kinds. We'll talk a little bit about sole proprietorships, partnerships, limited liability companies, which are very popular, sub-chapter S corporations, and C corporations. We'll start out, and I'm going to use some slides that once I get this to work, there we go. The first discussion I want to talk about is sole proprietors. We're all sole proprietors. They're the easiest entity to start. You simply need a bank account and away we go. If you have employees, then you would of course have to apply for employer ID number with Internal Revenue Service, but if you're a sole proprietor, no employees, it's way the simplest to start. But there are some disadvantages of sole proprietorship, and that's why people don't keep them. Usually if the business is successful, growing, and prosperous, and I'll review some of the positives and negatives. I have a list here. Limited liability, probably the first negative is that there is an unlimited liability risk if you're a sole proprietor. All your personal assets and your business assets could be drawn into a court case liability situation if there was something went wrong with your business. The Internal Revenue Service, as far as their audit risk, sole proprietors, self-employed business people that file on a Schedule C are probably the single highest audit risk that the Internal Revenue Service pursues, mostly because people that are sole proprietors tend to try to cheat more because they have no regulation as compared to partnerships and corporate entities. Continuity of life, and that can be an issue when we get to corporation discussions. You'll find corporations live forever. As individuals, we don't live forever. Some try, nobody makes it. So the continuity of life of a business as a sole proprietor can be relatively short, a lifetime. Number of owners, it's one. Sometimes with businesses you'll have the spouse involved. Obviously that would be two owners, joint ownership there. Family businesses, there may be other joint ownerships, but when you go beyond a husband and a wife, you're into a partnership. Fiscal year end, can't do that. It's going to be a calendar year for your tax purposes, business cycle. That could be a disadvantage if your business has a definite cycle to it. And I'll give you an example of that when I get into corporations. Health insurance is deductible for all individuals that are self-employed. It's only deductible against the income tax, not against the self-employment tax that comes off your Schedule C or Schedule F, unless, and the next option I have here is medical benefits. The medical benefits that you may be providing to your employees, and if you employ your spouse as an employee of your business, then we start playing interesting games where that employee is 100% deductible for the health insurance and the fringe benefits, and because your spouse is such a wonderful employee, you're going to cover her family, which includes you, and so that's a backdoor way of getting complete coverage as a sole proprietor for your medical benefits, both out-of-pocket and health insurance. And that is a big deal because in that case, you put it over on your Schedule C or Schedule F, and then it becomes deductible both for income tax and Social Security tax. And Social Security tax is probably the biggest tax that most sole proprietors pay, unless they're making a tremendous amount of money. Self-employment tax, we'll talk about that a little bit later. I'm looking at my chart. The tax rates that a sole proprietor is going to pay tax at is going to be the individual tax rates. Approximately $65,000 for the first 15% rate, and then from $65,000 to $120,000, it's 25% marginal tax rate. Corporate rates are a little more accelerated, and we'll talk about that later. Self-employment tax or Social Security tax, the income limit for 2008 is over $100,000, and it's 15%. So right off the bat, if your business, downtown Main Street business, nets $100,000 and you're sole proprietor, you're going to be stuck with a $15,000+ self-employment tax plus the income tax that goes with it. That's why it's really critical to get the health insurance and medical fringe benefit deductions on the Schedule C or Schedule F. Are they expensive to establish? No. Go to the bank, open a bank account, call yourself a name, go to business. Not a big problem. As far as the administrative costs, they're not too bad. As far as getting your profits transferred from your business into your personal life, okay, I make $100,000 on my hardware business downtown, but I want to buy a high-speed ski boat over here. Can I do that? Yes, you can. If you can afford it, that's your option. The money's all yours to work with. You'll find in other entity structures, transferring profits from the entity into your personal spending pattern can be more difficult. And so that's an issue there with sole proprietors. Partnerships, next step up, probably the next most common entity structures, general partnerships. They work well if you're dealing with father-son on a farm. It could be two guys decide they want to have a landscaping business. And so they decide, okay, you've got the horticulture background, and I've got the mechanical background, and you do this and I do that, and your two skill sets complement each other. Partnerships work nice that way. It allows you to pool resources, capital resources, to buy equipment and go. But partnerships have their disadvantages, just like any other entity. The biggest single disadvantage is the same one we had with sole proprietors, and that's limited liability. It's unlimited liability. Your partner decides to, he's doing a landscaping business and he destroys somebody's, I don't know, tears up some water line, floods a house. You've got a $200,000 disaster somewhere. Your business is very small, you don't have insurance, all your assets of your business are liable because your business was part of the problem. That person is liable because they were the one operating the piece of machinery. And guess what? That other partner who's the horticulture guy, who had nothing to do with the problem, all of his personal assets could be drawn in too. I really dislike general partnerships for liability considerations. I encourage my farmers, who are my primary customer base, to keep adequate liability umbrella policy, and I think that's a good plan whether you're in agriculture or not. Audit risk for general partnerships has been very low, so if you want an entity where the IRS is not going to bother you, partnerships are the one. Continuity of life is also the same as sole proprietor. I have a partnership of two men in a landscaping business and one of them gets killed in an accident, the partnership's over. The partnership lives as long as the entities that are part of the partnership. So it's not something that is easily passed down to another generation or passed on. It can be sold. A partnership interest can be sold to another group of partners. That can be the case. Partnerships can have as many partners as you want. Hundreds, thousands of partners. It becomes ridiculous when you get that many cooks in the kitchen, so to speak. But certainly partnerships had a lot of flexibility on how many partners you can have. The health insurance issue, yes, health insurance can be deducted against income tax again, but the whole concept, as I described in the sole proprietorship, where you can employ a spouse, do the fringe benefit for the spouse and the owner, operator, employer, those options are not available in a general partnership. And so partnership's second biggest weakness is their fringe benefit deductibility. It's just not as good as it is in a sole proprietorship or in the C Corp, as we'll find later. So fringe benefits are pretty much out. Tax rates of a partnership are at the individual rates, just like I told you with sole proprietors. 15% for the first $65,000, 25% for the next up to about $120,000. Those brackets are indexed for inflation, move up. Election may change that, but those are the rates that we're dealing with in 2008. Are they expensive to get established from an administrative cost? No, they're really not. Most people don't do it right. This is my concern and point I'd say here is, at least in farming partnerships, many of them do not have operating agreements, formal written operating agreements or partnership agreements. They should have, they don't have, and that's where they have problems. Because if anything goes wrong or there's a disagreement between partners, it's that partnership agreement that establishes the criterion that you're going to operate under, and who's on first and what's on second and I don't know's on third without it. And so you should get legal counsel, get you a lawyer that can set up the partnership. Don't go with a boilerplate standard thing. Think through how you want that landscaping business to operate and who has what responsibilities, and document those so that it kind of becomes a means to hold each other accountable. The worst case scenario is I'm doing all the work, sweating out in the heat, doing all the work, and that other guy's doing nothing. And how many years do you want to do that? That partnership agreement gives you some criterion to evaluate performance on even. Can you distribute profits out of a general partnership? And yes, you can. We'll go back to the example I said earlier. If we made $100,000, the two partners in my landscaping business example could draw out up to that $100,000. But here's where we get in trouble. Partner that's the guy doing all the work goes out there and I need $25,000 I want to draw out of my partnership. The other one decides he wants to buy a cabin in Colorado and make the down payment and needs $75,000. Well, okay, we drew $100,000 out of the partnership, but it's not equal to their interest if it's a 50-50 partnership. So what happens is the $25,000 draw is okay. So he has a capital account. He earns, profits go into the capital account, distributions come out. So if he earned $50,000, his half of the 100, and takes out 25, he still has $25,000 in his capital account. The partner that puts in 50 from his earnings but pulls 75 out has exceeded his capital account, and technically the excess distribution is taxable to him as a long-term capital gain. Now that's not a bad tax rate, but I can tell you that the partner that only pulled 25 is not going to be happy with the one that's sucking the 75 out of the partnership. And so those are issues that general partnerships can deal with, and you want to be careful about. You need good communication between your partners, and that's true with any business entity. If you have good communication, you're probably going to get along fine, but if you don't, you got problems right off the start. That's why, honestly, a lot of people like sole proprietors. They only answer to one person, themselves, or maybe the wife, which maybe is the main one. We'll see. Limited liability companies are a very interesting character. They are generally formed as partnerships, but the misconception about a limited liability company, LLC, is they can elect to be taxed as a partner. They can elect to be taxed as a S Corp, or they can elect to be taxed as a C Corp. They are a chameleon that can have, and in fact, you can have a single member LLC. So what you have is a limited liability company can look and smell and taste just like all these entities we're describing today. And it's purely a matter of what you elect with the Internal Revenue Service. The state of Kansas really doesn't care. General partnerships, as we talked about a little earlier, are not registered with the state of Kansas. When we move into LLCs and corporations, now we have a legal entity that has to be registered with the Secretary of State's office in Kansas. It is a much more formal entity. You will have an operating agreement with your LLC partnership, or articles of incorporation would be similar language if you elect to be an S Corp or a C Corp. The big advantage of limited liability companies is they have limited liability, as the name would imply. It does not eliminate liability, but it does reduce it. We'll go back to our landscaping business, and there's a litigation of some sort, and the guy that, obviously the company's liable if it did the damage, and the guy operating the piece of machinery would be liable, but the other partner that was not involved, only an investor, his personal assets are not likely, extremely unlikely, to be drawn into a litigation. So what happens with limited liability companies is it helps to protect the personal assets outside of the company. Now, you can have company liability and personal liability for the one that did the damage. So it's not a guarantee, but it does help reduce the risk over a sole proprietorship where everything's at risk, and a general partnership where all partners assets are at risk. So that's just an issue there. That's probably the biggest single contributor to the popularity of limited liability companies. Is their audit risk very high? I'm showing on my table low. They tend to look at them, the IRS tends to look at them as partnerships. The majority of limited liability companies are formed as partnership entities. They work and operate like partnerships. That's why I put them in the next line of sequence, because most of the attributes of the LLC partnership is just like a general partnership, with the exception of the limited liability. That's the one big difference. That's a significant difference. The other thing about continuity of life, the reason I put in my table maybe, is if it's elected to be a corporate structure, then it has the same life as a corporation. If it's elected to be a partnership, it's going to have the same life expectancy as a partnership. So the tricky part about LLCs is somebody says, well, I formed a LLC for my business. Well, what does that mean? Is your business a partnership, an S Corp or C Corp? Or is it a single member LLC? It could be any of the above. And so just because it says LLC in the name does not mean that it's a corporate structure. It's just in the language of the name. Medical and fringe benefits, it will have the same attribute as its underlying tax entity. So if it's a partnership LLC, it's got those attributes. When we get done with S and C Corps, you'll find out that there are different attributes there. So it's just flexible depending on the entity style. The taxes are going to be taxed at the individual rate if it's a partnership or an S Corp, and they're going to be taxed at C Corporation tax rates if it's elected to be a C Corp. Is it inexpensive to get established? No. Now we've moved up the ladder to where our cost of establishing this entity, administrative costs are higher. We've also moved into the Secretary of State filing requirements. It's only $55 a year annual report requirements, but if you have enough assets in this thing, you start paying a franchise tax. Fortunately, Kansas decided they were running companies out of the state with too high a franchise tax. They changed the rules, and now the franchise tax is not a big deal. But it's still out there. I'd have to let you know that. Distributing income out of it works just like the partnership I described. S corporations are very similar, only there's probably, in my view, a bigger stick of penalty for that guy that drew out more than his profits. That really shouldn't be done. The other way to think about it is this. Conceptually, do you want to draw out 100% of your profits out of your business? What do you have left to reinvest? You decide, we need a new skid steer loader for this landscaping business. We need a chipper to do the tree stumps. But we don't have any money because we've spent it all on toys. Well, we're going to have to go to the bank and borrow money. How long do you think that's going to last? So the moral of the story is distributions of profits need to be true profits, and they need to be part of your planning so that you reinvest adequate cash to keep your business functioning. Let's go through the S corporations and note, and just keep in the back of your mind that LLCs could have these characteristics. Rarely do people form a limited liability company and elect S corporation. Why? Because why not just establish an S corp? Because you have all the same features. Subchapter S corporation, it's a corporation with a special election. And that S chapter of the IRS code is where that special election comes from. And the only really difference in the LLC and the S corp is that the neatest part about it is the profits of the S corp are not subject to self-employment tax. Now remember, that was the 15.3% Social Security on that $100,000 profit. In this particular case, S corporations don't have that at all at the current time. When Mrs. Clinton was senator and promoting her health care plan when she was a senator, one of the inside little pieces of information was she wanted to make S corporations subject to self-employment tax. So just because you pick this entity and you say, man, I can avoid this self-employment tax issue, there's no guarantee it'll stay that way because Congress keeps kind of playing games with the tax treatment. And this is the only entity that's exempt from Social Security tax or self-employment tax. But there's another little twist that you want to remember, and that is that if you're now we're a stockholder of a corporation, not a partner. So stock is a little different. It's kind of a percentage, undefined little percentage thing. And stockholders, three of us go together, form an S corporation. and one person can have 20% of the stock, another can have 40% of the stock, and the other one has 40%. But the rules of governance say those with the majority of the shares of stock win. It's a democratic form of government in the corporate structure. And so I own 40%, I do not have controlling interest. But if I get the person with 20% of the stock to agree with me at a annual meeting, then we've got the majority of the stockholders, our votes carry the day, and we establish the policy of the company. Partnerships, obviously they don't have quite that same mechanics, and so what happens is it's just who was the biggest bully usually wins the race. And so that's a little bit different. But the other point I want to make on your S Corp, and it's not in my list, is you absolutely do need to pay wages to the stockholders that are actively engaged in the business. We'll go back to our landscaping, and the one guy's doing the physical work, the other guy's doing the maybe some planning, the horticulture work, well, we need to get this certain kind of chemical and spray because we got this kind of bug coming in on the trees in this community. You know, they're staying on top of the business, and they're doing an important part of it. Both these individuals in the corporation need to be collecting wages. One of the problems we have, and I put in here that audit risk is medium with S Corps, is because there's been a habit among non-farm S corporate structure, primarily in the construction business, where people say, I'm a contractor, I put furnaces and air conditioning in these new housing developments, okay? And so my business does that. If I do it as a sole proprietor, I'm going to get zapped for all the Social Security tax on all my profits. But if I do it as an S corporation, well, I don't have to pay Social Security tax on my profits. So I'm not going to pay myself any wage. All of the net income is profit. Now, you tell me, but don't you think there's some labor involved in installing heating and air conditioning systems? Absolutely. So he needs to pay himself a wage for that part of the work, compensate him for his labor, and then the profit in excess of wages would be distributable and not subject to Social Security. So I have a rule of thumb with the Internal Revenue Service that works really good. Pigs get fed, hogs get slaughtered. So what happens is if you get greedy and try to avoid taxes too aggressively with your S corporate structure by not paying yourself an adequate wage, you can just expect to be audited and expect to lose right now. So there's a balance here. I tell my farmers, pay yourself $25,000, maybe $30,000. If we've got a profit of $100,000 and we pay the one guy in this landscaping business, we pay him both $30,000. That's $60,000. But we've got $40,000 of income, that's profit, in excess of wages that we're not going to pay Social Security tax on. Well, we've still avoided $4,500, $5,000 worth of tax by structuring it in a way that makes sense, passes muster with the Internal Revenue Service, and makes a lot of sense as a business. The fringe benefit stuff with S Corp's a little bit tricky. You can do the health insurance. The out-of-pocket medical and the fringe benefit medical are trickier, but we can, if you run it through a highly deductible health insurance plan and a health savings account. If you use that mechanism for your fringe benefit, the subchapter S corporation can fund your HSA. Those funds can be used to pay your out-of-pocket medical, and then it becomes deductible on the front of your 1040. So if you work it right, you can get most of the benefits of the same thing we talked about with sole proprietorship. Are they inexpensive to establish? Corporations are not. They're not more expensive to establish generally than a limited liability company. But they're going to be the same kinds of things. The Secretary of State of Kansas has got to first approve that your name is yours. There cannot be two corporations with the same name. So we can't have two, Zero Inc. Corporations out there. No, we can't. Or landscaping, Hayes Landscaping. Well, we got two Hayes Landscaping Incs. No, you have to change the name somehow. That's part of their regulatory work. The other part of it is annual reporting, documenting who the stockholders are, the board of directors. With the LLC, you rarely have formal meetings and board of directors, whereas inside the corporation, you should. You literally should. It's just like having a 4-H meeting. You should go through your Robert's Rules of Order, and you should say, okay, here's the president of the board, and we have these issues before us for our corporation. Have the annual meeting. One of the fringe benefits that's not on my chart about corporations is that the annual meeting can be held at somewhere. I don't get real rambunctious. I have a few of my farmers that do their annual meetings at Breckenridge in the wintertime and conveniently go skiing and pay for the transportation costs of all the stockholders to come to the meeting. I have some older gentlemen, older family, where the kids are owning stock in the farm corporation, but they've all left home. They've all moved away. Mom and dad are still on the farm. We pay mileage to get the kids back for the annual meeting. You can be creative. I'm not real wild about cruises to Alaska or Hawaii, but I've got people wanting to do that. And that's one of the areas where corporate abuse and a little bit might be part of it. C corporations are almost identical to S corps. I missed one point on my S corps, let me back up. You can distribute the profits out of the S corporation, much like we discussed with partnerships and LLCs. But that is the negative in the C corp. The C corporate structure, you cannot distribute profits out of the corporation conveniently. And that's a real problem. We go back to the example of our landscaping business, and I paid Joe $30,000 and Fred $30,000. I've got $40,000 worth of profits. What's going to happen? Those profits are going to be taxed inside the C corp. The C corp itself will pay taxes. None of these prior entities pay tax by themselves. All of their profits are distributed out to the investor or partner or sole proprietor, and the taxes are paid at the individual rate. Whereas the C corporation, it's going to pay at the corporate rate. The first $50,000 is 15% money. Remember what the individual was? The first $65,000 was 15% money. The next $25,000 in a corporation, from $50,000 to $75,000, the tax rate is 25%. Well, on an individual, it's from $65,000 to $120,000 is 25%. Getting the picture? Then the corporate tax rate goes up to 30%, and it peaks out at 35%. Now, in the politics of the election, you've heard candidates say, well, we shouldn't let corporations make the kind of profits they do. They're not paying enough tax. We want to raise corporate taxes. Whereas other people will say that's a foolish thing to do because all it does is pass the cost off to the customer, which is generally the case. So my point here is, one of the negatives for a C corporation is if you're very profitable, $200,000 worth of net income in your C corp, you're going to pay more tax under the C corporate structure than if you paid tax as an individual, just because of the nature of the tax brackets. But the big positive with C corporations is they are the queen of fringe benefits. You need a swimming pool in your backyard or a sauna because you have arthritis, get your doctor's deal, the C corp can deduct it. I'm trying to think, exercise equipment, and and where do we get this from? General Motors decides that it's to the business purpose, it's to their advantage as a company to provide a cafeteria for all their employees on location, so the employees don't leave and come back and waste time. Let's say some corporations in bigger cities, they'll provide a daycare. They'll say, you know what, the only way we can get qualified ladies to work for us is to have a daycare business. And it may be the guys. We need it, so we will have a corporate daycare on location. It's deductible to the corporation. It has to pass muster of meeting the test of, is there a business purpose? Can you justify it because it's good for the business, it's good for the employees, which is also good for the business. So those are kind of interesting things. It's rarely a problem with my farm customers. I mean, we start talking about making the house deductible and a few other things because they're required to live on the farm because they have livestock, and if the electricity goes off, the water's gone, snowstorm comes in, we could require them to live on the premises. The problem is, if you're a business in town, our landscaping example, is there a business purpose for the house to be paid for by the corporation when they live 5 blocks away from the job? No. So you have to think through that. But in some specific cases, particularly with the medical's no problem. We can do the health insurance, do all out of pocket. It's very easy. It's no argument with the IRS on health deductions inside the C Corp. I have a classic example of a farmer that he has arthritis in his 50s, and the infusion treatments are over $1,000 a month, and the health insurance premiums are huge, and his son and daughter-in-law are having kids, and so we're having babies. We got medical expenses running all over the place, and we got livestock on this farm. It's a cattle operation. Doesn't it make sense to maybe use the fringe benefits of the C Corporation, the deductibility of those fringe benefits, as part of a good tax planning maneuver? And so we've used that for that particular purpose. And so that gives you a pretty good flavor of all these entities. My personal favorite is the S Corp, if you hadn't gathered that. But obviously the simplest is sole proprietor. The most complex to operate and be a part of is probably the C Corp. Limited liability companies are the most popular right now as newly formed entities. Be very careful that you examine the options in your LLC. There's not a thing wrong with LLCs, but they need to be set up so they accomplish what you need for your business. And many times, at least in my experience with the customers I work with, tax avoidance becomes the primary purpose of the entity, and it shouldn't be that. I think there's good business reasons for being in corporations or LLCs, and that is primarily the liability risk. If you're in a type of business where liability is a problem, then you need to be thinking about moving into entities that reduce that risk financially. The entity that's the easiest to pass on to the next generation, or the easiest to dispose of. Another negative on the C Corporation would be that if you sell the C Corporation, you sell the stock, it's just a capital gain. That's okay. But let's say we liquidate the corporation. We shut down the corporation. Nobody else takes it over. We're going to stop the business, liquidate the corporate entity, take it out of existence, and pull the cash out of it. That's a very expensive tax maneuver. Approach that very, very cautiously. And I'm sure there's in and out of town businesses that have got caught with that. My farmers have been caught with that. S corporations, it's a little bit of time consuming, and LLCs to get out of, but they're not that bad. They're a single tax event to get out. C corporation, you would end up paying tax on some assets twice, and that's a real problem. So you want to think about, a lot of times, like I said, people get in because of the initial benefits, but they're not thinking about the end of the game. And so business planning should be molded around what's best for today and what's flexible for the years I want to run it, and which entity is probably the best to step out of in the future or transfer. So I hope you find that useful. It's been good to visit with you today, and obviously if you contact the Extension office here in Hays, if you had questions, I'd be glad to help you with some questions if you had them in the future. Thank you.